Alright guys, so I hope you're doing fine as always. In today's video we will have a look at the main three order types, that being market orders, limit orders and conditional orders. Of course there are other types like chase limits, scaled orders, TWAPs, icebergs, etc. But these are very specific and we won't have a look at those in this video. The main three order types 99% of us will use are just market orders, limit orders and conditional orders. Now, very basic, what are these orders? To keep it simple and visualize it, let's say you walk into a coffee shop to buy a coffee. And you have three choices. You can either say, give me a coffee right now. I don't care about the price, I just want it. Or you can say, I'll only buy a coffee if it's $3 or less. If it's more expensive than this $3, I don't want the coffee at all. Or you could say, buy me a coffee automatically later if the price drops. So you set the condition and let the system react for me. Those are basically the three main ways we trade in financial markets as well. In this video, I'll explain the difference between market orders, limit orders and conditional orders, what they do, when to use them, and why choosing the wrong one can actually cost you money. So let's start with the simplest one, that being market orders. A market order means you will execute my trade immediately at the best available price. Speed is a priority here. When you press the buy or sell using a market order, the exchange instantly matches you with someone on the other side of the trade. You're not choosing the exact price, you're choosing an immediate execution at the best available price. For example, let's say Bitcoin is trading around 70k. You hit buy market, your order gets filled instantly, but maybe at $70,010 or $69,990, depending on what prices are available at that exact moment and the size of your order, of course. This difference is called slippage. And it happens because markets are constantly moving and you match only the next available limit order. And like we said, your order will be instantly executed. Now, why do traders use market orders? Market orders are useful when getting in or out quickly, and when the speed of it matters more than getting the perfect price. For example, some common scenarios are exiting during a crash. When markets are falling fast and you want out now at a better price than later, you just click market order. When entering fast breakouts, when price is surging and you want to catch the momentum immediately without waiting, you click market order. Or immediate risk management, closing a position right now to limit losses or lock in profits when you see something you don't like in the market or you hear news you don't like and you want to close out immediately without waiting for a pullback, for example. Now, what are the advantages of market orders? Like we already said, it's an instant execution, so you're immediately in or out your trade. It's extremely simple to use, it's just one click of a button, and you can see all the data and wait for a specific reaction you like or you want to see, for example, before entering a trade. Now, what are the disadvantages? You have no control over the exact price. Especially with lower liquid coins and a big order, you will have quite some slippage. And this can become very expensive in very volatile or illiquid markets because the slippage is so big. So to summarize, a market order gives you speed but less precision. Now let's talk about the limit orders, which is almost the exact opposite. A limit order means I will only buy or sell at a specific price or better. For example, imagine Bitcoin is trading around $70,000, but you think $65,000 is a better entry. So instead of buying immediately at the market price of 70k, you place a buy limit order at 65,000. And then you wait. Your order is just sitting there waiting. This trade will only happen if the market reaches your price of $65,000. And if price never drops that low, your order will never get executed. The key concepts here are, with limit orders you control the price, but you give up certainty of execution. So you want to enter at a specific price, but you're not sure you will catch the trade you want, because price might not get to your level. When the order is placed, it's a waiting game till the market hits your prices. And if price never hits the level you have on a set order, the order will never execute and you miss maybe the whole move. Now, why do traders use limit orders? For example, some common scenarios are they want to buy near a support or key area, so they set their limit at a key level where you believe the price will bounce. The other way around, selling near resistance or key areas again, so they place sell limits at key levels to take profits at optimal prices, for example. Another big point is avoiding emotional entries. You have your trade pre-planned, so you're not making impulsive decisions in the moment itself. Now, the big advantages are you have full control over the price you want to enter and exit the market, and it helps you avoid overpaying due to slippage. Disadvantages: your trade might never happen and you can miss fast-moving opportunities. So if market orders are about speed, limit orders are about patience and precision. Finally, we have the conditional orders. These are orders that only activate when a certain condition in the market is met. Instead of manually watching the charts all day, you let the system react automatically. Think of a conditional order as an automation for your trading decisions. Some examples of conditional orders are your stop loss. So let's say you want to buy Bitcoin at $70,000, but you don't want to lose too much if the trade goes wrong. So you place a stop loss at $67,000. So if price drops to the $67,000 level, you will get out of the trade. So you have input this stop loss of $60,000. The platform will automatically sell for you when price touches this $67,000. And this is proper risk management. And it happens automatically. So your stop losses are conditional orders. But conditional orders also work for entering trades, for example, a breakout entry. Maybe, let's say price is again at $70,000, but you only want to buy in after the price proves its strength by breaking above a key level you have charted out at, for example, $72,000. So you set a conditional order that triggers a buy once this 72,000 level is reached. The trade will only activate then when these conditions become true. Personally, I don't use conditional orders often for entries, as this is not my personal trading style, but it definitely has good use cases for different kind of breakout traders, for example. The advantages of conditional orders are that it automates decisions, no need to watch the charts 24/7, it protects you against large losses as it's your stop loss, and it removes emotional reactions if you had a predetermined plan. The disadvantages are that it's slightly more complex to set up, and a poor placement can trigger orders too early, for example. Why do people rely on these? You pretty much create a robotic if-then trading setup. If this happens, then execute this type of order. And maybe the biggest reason is markets move when you sleep too. So conditional orders for stop losses make sure you are safe even when you are asleep or not in front of the charts. And you can execute specific orders based on a specific scenario even when you're asleep or away for a while. So here's the easiest way to remember everything. A market order prioritizes speed, as your order will execute immediately. A limit order prioritizes price control, as the order only executes at your price. And a conditional order prioritizes automation and risk management. Keep in mind, none of them are better than the other. They're only tools for different situations, and you can mix this up. You can use different type of orders in your trading. One of the biggest beginner mistakes is using only market orders for everything. And here I refer mainly to the stop loss part. A lot of beginners don't have a preset stop loss, which remember is a conditional order on default on most exchanges. But they won't have a stop loss set at their order, and they only exit, if they exit at all, with market orders. This is a very, very dangerous game. When the market pumps or dumps really fast, even when you're watching the chart, this can liquidate you in seconds. So always have this stop loss. Again, this goes back to risk management, as we have spoken about in multiple videos. As traders gain experience, they start combining all three types of orders. So they use market orders when speed matters, they use limit orders when planning entries, and have conditional orders mainly for managing risk automatically. If you understand these three order types, you are already prepared for most of the market scenarios, and you understand how most trades actually happen behind the scenes. Now, how do I personally use these order types myself? Market orders. I use market orders when I need more information at a certain level. I want to see a certain reaction at a certain level because there are other zones of interest as well. When I see a strong breakdown or push up and I want to catch the momentum and I'm happy at the current market price, I will enter the trade with a market order. Of course, there still needs to be a good risk to reward. And when I'm fully watching the charts and quickly scalping, for example on Nasdaq or gold, etc., I usually use market orders as well. For these type of market orders, my main trading confluences are strong reactions in certain zones with strong vectors or strong bounces in identified vector zones. Also stopping volume candles and EMA bounces or crosses. Limit orders. I use limit orders when I expect a bounce in a specific zone, the chart fully aligns with my strategy, The specific level is the last bouncing zone for price to move that makes sense. For example, the last vector candle to the upside. You have probably seen quite a few of my trades which are based on this principle, that this is the last vector candle to the upside, so I expect the bounce back down from there, and I have this entry set as a limit order. Also in illiquid markets or shitcoins with a thin order book, and my order size is a bit big for these type of coins, I use limit orders to avoid big slippage. I also set limit orders when I don't have time or don't want to watch the charts all day. For these type of orders, my main confluences are vector alignments over multiple time frames, meaning these zones are vectors on multiple time frames, example 4 hour, hourly, 15 minute, 5 minute, etc. Or liquidity zones or harmonic patterns. Usually these are at liquidity zones or support and resistance zones. Or when I'm looking at the whale order book and I see big whale orders which are not spoofs, I might set a limit order right before this whale order too. And finally, the conditional order. I use conditional orders when, of course, I place my stop losses. Just filling in your stop loss is on almost all exchanges a conditional order on default. This for both the execution on market or limit order for the stop loss. You could have a conditional stop loss that most of the times triggers your stop as a market order, but you could also set it that it triggers your stop as a limit order. Like I said earlier, I very rarely use conditional orders for entries, but when I do, it's usually for continuation trades on the higher time frame when I don't have access to the charts for a bit. For these type of orders, my main trading confluences are a vector continuation. Again, this is very rarely that I use this, or a higher time frame structure break and consolidation area break. So that was in a nutshell the 3 main type of orders. I hope this was somewhat clear, and as always, if there are any questions, please feel free to ask it in the comment section or on the Discord server. So then it's only left for me to thank you for watching, and I'll catch you guys in the next one. Take care, see ya, bye bye.